The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everyone, and welcome to Squawk Box. I'm Karen Cho with Juliana Tattlebaum, and these are your headlines. President Trump threatens the European Union with a 200% tariff on alcohol imports, ramping up the rhetoric as he promises to follow through with his plans.
We've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars. We're not going to bend. We've been ripped off as a country for many, many years.
The S&P 500 closes in correction territory as Wall Street is roiled by a week of tariff and recession fears. US Treasury Secretary Scott Bessent tells CNBC he's not concerned about the volatility.
The reason stocks are a safe and great investment is because you're looking over the long term. If you start looking at micro horizons, stocks become very risky.
Markets await BMW earnings after indications the automaker would see a significant drop in quarterly profit. We'll hear from CEO Oliver Zipse at 7:30 GMT. And Russian President Vladimir Putin agrees with the principle of a ceasefire in Ukraine, but issues several prerequisites for peace, leading to criticism he is stalling the process.
We do not set conditions that complicate things. Russia does. And as we have always said, the only one who will delay anything, the only one who will be unconstructive is Russia. They need war. Putin has stolen years of peace and continues this war day by day.
There's little doubt that the tariff threat has caught up with markets this week. I saw one commentator suggesting, look, it's a haunted house that's already rattled and now there's a mouse problem and a mouse has wandered into the haunted house. I've got to say, I'm not that worried about a haunted house. It's not actually that scary, is it? You know something's going to jump out at you. You know where the usual suspects are. But perhaps the mouse problem is a little bit worse because that's frightening. That is something you can't eradicate. It sticks around for a while. You get the inspector and the pest guy, and still the mouse problem lurks and it goes on. And that's the problem if we're talking about a mouse problem.
Absolutely. I think that markets, they don't know where the Trump administration is going to go next. And that's the problem every day. The headlines change. And to try to prepare in that scenario and position in that scenario is incredibly difficult.
Yeah, and there's been a lot of mousetraps this week. The dip, was it worth buying the dip? Or was that another mousetrap? We're going to get into the casualty list shortly. Well, President Donald Trump says he will impose a 200% tariff on European alcohol imports if the EU pushes ahead with its plan to impose a 50% levy on American whiskey. A move that itself came in retaliation to the US president's latest tariff on steel and aluminium. Shares in European drink makers tumbled. LVMH suffered its 9th consecutive negative session and longest losing streak since 2011. Speaking to reporters in the Oval Office Thursday, Trump said he will not back down in the US's escalating trade war with its allies.
We've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars. We're not going to bend. We've been ripped off as a country for many, many years. We sell no cars to Europe. I mean, virtually no cars. And they sell millions of cars to us. They don't take our agriculture, we take their agriculture. It's like a one-way street with them. The European Union is very, very nasty.
President Trump's latest comments cap a week where trade policy claimed the spotlight as the U.S. administration clashed with governments on both sides of the Atlantic.
Outside countries who just leech off of us, lean on us, earn money off of us, they've got to start to pay. President Trump wants the American people to start to understand the External Revenue Service should start to pay. Yes, some products that are made foreign might be more expensive, but American products will get cheaper, and that's the point.
There's someone who's trying to weaken our economy. Donald Trump, as we know, has put, as the Prime Minister just said, unjustified tariffs on what we build, on what we sell, on how we make a living.
We will apply maximum pressure to maximize our leverage. That's why today we're moving forward with a 25% surcharge on electricity exports. for the 1.5 million American homes and businesses that Ontario powers.
I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
Threats going back and forth, tit for tat. I've agreed to suspend temporarily, and we always have that tool in our toolkit, until we sit down over the next day or two. I'll be heading down to Washington.
The European Union must act to protect consumers and business. The countermeasures we take today are strong but proportionate.
European Union's been very tough. And it's our turn, too. You know, we get a turn at that also, but they have not been fair. If they charge us 25 or 20% or 10% or 2% or 200%, then that's what we're charging them.
Thanks to a lot of bravado, we've ended up in a very black and white world of winners and losers. So shall we go through the winners? For me, Canada, losers, I should say, Canada, the likes of Europe, the United States, I'd put in the loser category for now, given what happened on the markets. Winners, the UK. Somehow the UK managed to emerge somewhat unscathed. The list, I think, on markets, losers. European stocks got caught up in the rout. We finally saw selling there. The US names, the Dow, the S&P, the NASDAQ, the ARK Innovation Fund, the FANG stocks, the bank stocks, some of the winners. Utilities held up okay, unscathed. The dollar, can you believe the dollar's actually flat for the trading week? I think that's extraordinary. Bond markets too, somewhat unmoved. Now, gold, one of the rare winners out there.
Gold has had an extraordinary run, clearly an indication of investors seeking safety in what has been an incredibly difficult market to trade. I would come back from a market perspective to something we were talking about at the start of the week. What's behind the heavy selling that we've seen? And I think a lot of it comes down to these hedge fund unwinds that we've seen. Hedge funds being forced to shrink their books has caused a lot of the unexpected selling and some of the names that have done really well coming down in a really significant way. And I think one thing to consider here is, where are we in that process? Are we going to see continued shrinkage of some of these major hedge fund books? The FT reporting that Millennium has seen massive unwinds of those books there, and they have an outsized impact on the market. So I think that's just one thing to factor in here when we talk about the magnitude of the selling that we've seen.
The tariff warfare has taken a baseball bat to the momentum trades that were in the markets from 2024, 2023, perhaps even before that. And this week, it wasn't just the semiconductors, the technology names. It was also a couple of European names. And LVMH, of course, got caught up in that yesterday as the markets then turned focus on whether we're talking about 200% tariff on some very high-end alcohol out of Europe. So it felt as though if you've been a high flyer in recent years, then a lot of heat is coming out of your share prices. Question is whether this is a healthy move, whether we're talking about some sort of healthy shakedown correction after very stretched valuations in some quarters of the market. So are we in better territory as a result now, or is it incredibly dicey? Because I've got to say, when you see a market come off like this in previous cycles, we've had the dip buyers move in very aggressively. They've tried to this week in parts, but they've not been rewarded so far because of all the uncertainty that still lies ahead around tariffs.
I would also say that Scott Bessent, he talks about the focus of the administration being on the real economy, that they're not too concerned about what's happening in markets. They're calling it short-term volatility, but you have to remember that in the U.S., retail investors make up a significant portion of the market. So is it really fair to separate those two, to talk about the real economy as something completely separate from the stock market? I would argue there is going to be a knock-on impact if we do continue to see volatility like this.
I'm not sure the retail investor understands the art of the deal. To me, we've seen a ton of bravado that was everything that the art of the deal had promised. And we saw it even yesterday, the up in the ante on the rhetoric, retaliation met with retaliation again through the lens of these tariffs on European liquor. And does it work at this point? Because is Trump willing to take it to the nth degree? And I think that's what we're seeing. Very different approach out of the UK. And there was some commentary that perhaps this is a standout moment for Keir Starmer, some sort of negotiating power that he has, because it hasn't taken the same approach as Canada and Europe. So for me, it's going to be very fascinating to see how this bravado story plays out over the next 7 days.
Absolutely. Well, let's take you to the market moves that we've just been talking about. Yesterday, we saw U.S. markets close down once again. So that sigh of relief that investors had breathed midweek has proven short-lived. You got the Nasdaq falling 2% deeper into correction territory. The S&P 500 also now in correction territory, down 10% from its record close just last month, which tells you about the speed of this major shift in market sentiment. The S&P closing down 1.4% yesterday, and the Dow losing more than 500 points. From a week-to-date perspective, let's take a look at the moves and put them into a broader context. The Dow off 4.6%, the S&P, the Nasdaq also down more than 4% for the week. The S&P now on pace for its worst week since March 2023. Now, I just referenced the comments from Scott Bessent. Let me tell you exactly what he said. He told CNBC that the recent market action should not worry investors.
I'm not concerned about a little bit of volatility over 3 weeks, because if you look over the long term, the reason stocks are a safe and great investment is because you're looking over the long term. If you start looking at micro horizons, stocks become very risky.
Looking at the Treasury market right now, yields higher across the board. You've got the 10-year trading around just under 4.3%. The 2-year out of the front end, just under 4%. Dollar crosses. Let's take a look at where we stand right now. Euro dollar holding steady this morning around the 108 mark. Sterling unchanged versus the dollar. Meanwhile, dollar yen is trading more firmly. Dollar Swissy as well. Now moving on to commodities. Karen flagged the massive run-up we've seen in gold, and quite notable. Yesterday, we saw gold cross the 3,000 mark for the first time ever, hitting a new intraday all-time high. We've come back below that 3,000 mark, but very significant in terms of the sentiment in market, reflecting that investors are seeking safety. WTI and Brent trading slightly firmer this morning. Asian markets. Here's the picture of overnight trade. You are seeing some resilience in the Asian market despite the sell-off on Wall Street yesterday. The Hang Seng up by more than 2% at the moment. Shanghai Composite in the mainland up about 1.7%. We are seeing a little bit of red, though, in the Korean market. Opening calls in Europe. Here is the picture. We're also looking at a bounce back in Europe despite that escalation on the trade front that we saw yesterday. We did see the Stoxx 600 pull back ever so slightly yesterday, but that story of continued of outperformance versus the U.S. continued in yesterday's trade, and we are looking now at a further positive trade in Europe at this point.
Coming up on the show, U.S. Treasury Secretary Scott Bessent telling CNBC the White House is focused on the long-term health of the economy as opposed to short-term gyrations. We'll bring you that next. Plus, BMW releases results this hour. We'll bring you our interview with the CEO, Oliver Zipser, at 7:30 London time. And we'll discuss London's attractiveness and the health of UK capital markets with the Lord Mayor of London, Alistair King. That is at 8:15 GMT.
What we're trying to do is create economic certainty. We're going to do it with the tax plan. We're going to do it with deregulation. If we put proper policies in place, it's going to lay the groundwork for both real income gains and job gains and continued asset gains.
U.S. Treasury Secretary Scott Bessent there talking to CNBC on Thursday, once again stressing that President Trump's policies are designed to focus on Main Street, not Wall Street. Well, Main Street's been hit too. Let's get to Neil Wilson, co-CEO of EJF Capital. Neil, there's been nowhere to hide on stock markets this week, and even some of the highly prized stocks that retail investors have been quick to acquire in recent years, those have been smashed by the tariff threat. How are you thinking about just how shaky the sentiment is still around markets as we look to wrap up the week?
Well, first of all, it's very nice to be with you again, Karen and Juliana. No, I think this kind of correction of 10% or so is somewhat healthy and was kind of overdue. And you're also seeing that rotation from growth to value names. But I think, to use your kind of haunted house and mouse infestation metaphor for a second, the fact that gold's up higher is a function of people just leaving the house. They're saying, look, Trump's intentional unpredictability is antithetical to a stock market that rises. And I think it's important for the audience to understand that Trump there's a sequencing in what he's doing. There's certain things he can do without Congress. That's deregulation steps, which he's been doing, and that was referenced by Secretary Bessent. And he can also do his tariffs or threaten his tariffs. And I think that's what he can do. And then DOGE, which the whole Department of Government Efficiency, that's macro irrelevant. It really, the numbers aren't relevant. So what people are doing, I think, smartly in the market are just getting out and just waiting, because ultimately, two things are going to happen. One, and we didn't talk about it at the top of the hour in the story, but they averted a government shutdown that was supposed to happen today. That was supposed to be the drama today. And the fact that the House was able to get their act together and pass a continuing resolution tells you they're going to be able to pass the tax cut extensions later in the year. And that's really significant. And that will be a good time and something better to look for in the future to come back in, and also the impact of deregulatory moves.
And Neil, I'm glad you picked up on the storytelling, because it's been rapid, hasn't it? We've gone from best house on the street, this US exceptionalism at the start of the year, to the haunted house, and now the mouse-infested house. So you say there could be something coming down the track as we talk about the tax side. But in the meantime, we've got maximum bravado. We've got the, well, if you're going to retaliate on tariffs, then I'm going to retaliate even more, and here's 200%. How do we think of that sort of narrative? And are we seeing entry points in some stocks, in some sectors, or is this just hands off, stand back, wait for the tariff warfare to settle down?
Well, I think there are pockets of things that you can do. I think, look, European stocks are looking more attractive, certainly because of the fiscal stimulus you're going to get with military spending, and then rates coming down. So I think Europe actually looks, on a comparative basis, quite interesting. I would note that yesterday the Senate Finance Committee passed a bill that's going to now go to the House on stablecoin regulation. So there is going to be some things you can do, not just in real gold, but in digital gold. That's going to help those stocks. But I think one thing we're not mentioning is that inflation is now not something inflation's sort of under control and heading in the right direction. CPI, PPI prints, the recent prints this week, they're telling you that things are drifting down to that 2%. And I think you just have to hold tight until June and look at the data, the sentiment data of consumers. We're focusing on the savings rate has gone way up in America. That means there's a jittery consumer. But look at that kind of data. Today's the University of Michigan sentiment on the consumer. Look at that kind of data and then hunker down and maybe you're able to come back in more fulsomely in the June timeframe, because we think there's going to be probably two cuts this year, one in June and one sometime in the back half.
Neil, one of the big features of the market narrative right now is the softness of the soft data in the U.S., but how the hard data has been holding up. And you just mentioned the University of Michigan survey, which we're going to get the results of later on. When do you expect and do you expect the weakness we're seeing in soft data to translate to the hard data? Or is there still a possibility that it doesn't ever show up in the hard data and it's just confidence jitters that we're seeing right now?
Yeah, I think it's more confidence jitters, and we're not seeing that there's going to be a recession. The job market is still strong. It's weakening, but it's still very, very strong from a historic standpoint. And you're gonna see some of the impact of the deregulation, increased M&A. That's all going to happen after this tariff kind of nonsense and bluster's over. But I don't think there's going to be something to worry about with a recession. I think you are going to just focus on some of the data that tells you how the consumer's feeling. And once we're through the tariff and the worry about cutting government jobs, because that's really affecting the just the regular consumer, that's going to take 3, 4, 5 months. And that's that hunker down period that I think is the market's reflecting with that 10% kind of correction.
Bessent, in his comments in the last 24 hours, suggested that the Trump administration is focusing on the real economy, that they're not worried about this short-term volatility the way that he framed it. But as I was just discussing with Karen at the top of the show, in the U.S., retail investors make up a significant portion of the market. And no doubt part of the reason that confidence has suffered in the U.S. is because of the sell-off we've seen in the stock market. So to what extent does that become a self-fulfilling prophecy that the sell-off on Wall Street creates the weakness in the real economy?
Oh, it's definitely a self-reinforcing thing, and the key data to keep in mind is when the stock market goes down so much so quickly, the wealth effect does affect consumer spending, and 50% of the spending of the consumer in America is done by the top 10%. So that when the stock market goes down, it does have an impact, becomes self-fulfilling. But I would just say, what Trump's doing is playing chicken with time, and again, if we just have to hope that the end game happens quicker. So when Trump goes after Canada and Mexico, the end game is getting some amendments to the USMCA, and he's going to get some amendments out of that. Are they going to be that meaningful? Probably not, but that's his end game. Europe, it's a little bit tougher to kind of handicap because the reciprocal trading is just messy. Frankly, the French make better champagne than the Americans do, and so why would you? You can't just say tit for tat. But it is a self-fulfilling loop of reinforcing bad sentiment, and I just think that that investors should just hunker in, get out of the haunted house, get the exterminator in, and wait 3-4 months before they really kind of go in, except for certain little areas that I mentioned.
Then pop the bubbly. Neil, I'm going to offend half the UK as well. I'm going to say a better champagne than the sparkling here too. It's all about the finish.
Well, it's going to be cheaper. It's definitely going to be cheaper soon here.
Hey,
right?
We've got some ready buyers to soak up some of the excess on this side of the pond. Neil, let me ask you about borrowing costs, because we did see a little bit of movement, but not much in light of the circumstances. I mean, the 10-year at 4.27%, grinding higher by about 0.07% on the trading week, flat on the dollar as well. You think there could be some more movement from here? Just explain that to us.
Yeah, no, we think that the 10-year is going to come in from here. It's going to be a function of a couple things. One, that the impact of inflation is, like I said earlier, inflation's coming down. It's coming down kind of smoothly. Jobs are still hanging in there, but they're weakening. And I think that it's basically that the 10-year went up after Trump got elected because there were concerns about inflation, but there was also expectations of tons of growth. And that expectation is come off a bit. So that's why we would expect the 10-year, to come down to 4%, maybe even a little bit below 4%. And I think if you look at the GDP prints for upcoming for the second quarter, that'll kind of also indicate, what happens in the trading in treasuries.
Neil, I can't work out whether you're an early bird or a night owl, because you're often 6 a.m. here in the studio and it's 2:23 in the morning there, and you seem to be fresh as a daisy. So which one is it? Early bird or night owl?
Well, when I'm in the UK, I'm an early bird, and when I'm here, I'm a night owl. So
man that doesn't
that's
sleep.
The situation.
Neil, thank you for joining us, and happy Friday for you there too when you get there. Neil Wilson, co-CEO EJF Capital, with us.
The Senate Minority Leader Chuck Schumer says he will now vote for a Republican-backed bill to fund the U.S. government for 6 months, a day after announcing Democrats would vote against the proposal. It requires at least 8 Democratic votes to pass after GOP Senator Rand Paul announced he would oppose the bill. Schumer announced his decision on the Senate floor.
While the CR bill is very bad, the potential for a shutdown has consequences for America that are much, much worse. I believe it is my job to make the best choice for the country to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
Russian President Vladimir Putin has laid out Moscow's conditions for a ceasefire in Ukraine, indicating openness to the US proposal for a 30-day truce, whilst warning of issues that need to be discussed with Washington. US President Donald Trump called Putin's comments promising but incomplete, but Ukraine's Volodymyr Zelensky struck a less optimistic tone, warning the Russian president is preparing to reject the proposal, accusing him of being too afraid to tell Trump that he wants to continue the war. NBC's Richard Engel filed this report.
Armata! In his first comments on President Trump's 30-day ceasefire proposal, which was already accepted by Ukraine, Russia's President Putin tonight said he's in favor of the idea, then gave several reasons why he's not agreeing to it for now. The idea itself is right, and we absolutely support it, but there are questions we should discuss, he said, suggesting he'll call President Trump directly. President Putin went on to say a military pause would give Ukraine time to regroup and rearm, while Russian forces are making gains on the battlefield, especially in the Russian province of Kursk, where Putin just visited, donning fatigues and speaking of victory and new buffer zones.
Well, we'd like to see a ceasefire from Russia.
Still, President Trump described Putin's comments tonight as encouraging.
He put out a very promising statement, but it wasn't complete. Now we're going to see whether or not Russia's there, and if they're not, it'll be a very disappointing moment for the world.
On the front lines in Ukraine, troops aren't putting down the guns yet. They doubt Putin is seriously considering ending the war.
This soldier is scanning the sky for Russian drones. Even with all this talk of a ceasefire, soldiers out here say they're seeing no let-up in Russian attacks.
They say it's time to give peace a chance.
Everyone is waiting to see if Putin will also agree. What do you expect?
Russia's commitments, this soldier said, are not worth the paper they are printed on.
President Trump's envoy, Steve Witkoff, is in Moscow tonight pushing the ceasefire deal. Here in Ukraine, President Zelensky called Putin's comments predictable and manipulative.
That was NBC's Richard Engel reporting. As concern grows in Europe around the U.S.'s commitment to its allies, Germany's parliament has begun debating Chancellor-in-Waiting Friedrich Merz's proposal to reform the country's debt brake, which would see some defense spending exempt from the stringent rules on state borrowing. Merz urged lawmakers to support the measure, warning of the need to significantly boost the country's defense capabilities.
The constant attacks on our infrastructure, drones, flights over our barracks, a hybrid war that is taking place, which has escalated massively in recent weeks, with insecurities greater than ever before. We must do something now to significantly increase our defense capability, and we must do so quickly, and with great foreign and security policy unity. Germany must return to the international stage as a capable partner in Europe, NATO, and the world.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.